afternoon, everyone. My name is Govind Rajan. We thank you very much for your time to attend our webinar, a very interesting topic of discussion among policymakers, economists, wealth managers, and pretty much anyone who considers himself to be an expert in the domain of macro. We sincerely hope that you will find today's session interesting and informative. Before we dive into this session, we take a few moments to introduce our company, Trustline Holdings, and also the key speaker for today's session, to the participants. Trustline Holdings is a 15 plus year old SEBI-registered portfolio management services company based out of Chennai. Trustline was born out of our passion for value investing. In fact, our story starts and ends with this. With this simplicity and focus, we have built a powerful story in small cap investing and a thought leadership in value investing. We have evolved a very robust due diligence process to mitigate the risks which are inherent in this space. We have delivered an annualized returns of north of 20% to our investors since 2007. Our asset under management today is roughly about 700 plus crores, 750 crores. And we have built an enviable client base of C-levels who form the majority of our 600 plus clients. Today's session is going to be anchored by Mr. Arunagiri, who is our founder, CEO, and fund manager of Trustline. Arun comes with 2 decades of small cap investing experience. The session is likely to be duration should be around 45 minutes, not longer than that, with 15 minutes built in for any Q&A. Without much ado, I hand over the forum to Mr. Arunagiri. Over to you, Arun.
Thanks, Govind, for a very nice introduction. Good afternoon, everybody. Thanks for the participation. Really appreciate for you all taking time off weekend to attend this. Really appreciate that. So the topic which we are going to be discussing is a very interesting one, like what Mr. Govind said. A lot of us are grappling with this debate. You know, when countries when economies which were celebrated not in the very past as miracle economy, when they can get into the doorsteps of IMF, we mean Bangladesh. What can happen to other countries in Asia, in emerging markets? Like we have seen worst crisis playing out in Sri Lanka. Nepal is in trouble. Pakistan is in trouble. Now, a celebrated economy like Bangladesh has also got into trouble with, with respect to their foreign reserves, forex reserves. So the key question which everybody is asking is this particular crisis likely to hit Indian shores? Or is our macro has come a long way from 2013 when it was clubbed as fragile 5? So that's what we are going to explore in this particular topic. So before we look at the macro risk profile for India, it would be very fascinating to look at, what causes these kind of crises. It happens in every cycle, right? It's happening in a very cyclical fashion. So it is really fascinating to look at, how this EM crisis pans out and what are the drivers behind it. And that will give a little bit of clarity in terms of where we are and how it's likely to unfold for us. So usually it stops, basically, most of the times, usually this particular crisis, the seed is sown when Fed starts basically easing its monetary policy, right? So basically at the start, you have a Fed which starts easing its monetary policy, the liquidity becomes abundant, and Fed starts cutting interest rates. And then it starts quantitative easing, which means they accelerate their bond buying programs, which throws again money into investors. So what happens in the process is, as a result of this, interest rates gets cut across emerging markets. The dollar index starts moving down, which means emerging market currencies start appreciating, and huge FI and FPI flows, they start flowing out of US into emerging markets. So they make the capital cheap, And this results in, basically risk taking starts getting rewarded, and it leads to asset price inflation. That's how the cycle plays out. So what happens in this kind of Fed easing cycle is the currency gets distorted. Basically, emerging market crisis, emerging market currencies, basically they start appreciating. So they start hiding the underlying problems like twin deficits, which most of the Asian emerging markets has as a root, problems. So as a result, I think the economy starts moving up, asset prices start moving up, and risk taking moves up, and all that happens in a very, very sequential fashion. At some point, the music stops. Usually, it stops when Fed starts tightening again, when it starts reversing their quantitative easing policies. They start sucking money out of the markets. So the liquidity becomes scarce. That's when I think the entire reverse dynamics plays out. In terms of dollar index moving up, money moving out of the FIs and FPA money start moving out of emerging markets back into US, which starts putting pressure on the currencies and economies which have taken earlier risk, and then they bloated twin deficits in terms of fiscal and current account deficits. They start coming to the surface. And this is how the cycle plays out. And this is when I think investors, the global investors, start looking at closely some of the macro metrics of emerging markets, EM economies. Now, if they smell a rat in any of those metrics, they start beating the currencies, and it leads to a vicious cycle, which finally brings the economy to the brink of bankruptcy. Usually it happens in a self-feeding, self-loop, feedback loop kind of a fashion, where initially this FI money starts moving out, the currency starts getting weakening. And as the currency falls down, I think if there is if the investors smell a rat in terms of any macro metrics, they start pushing out more money, which leads to further fall in the currency. And in a cyclical feedback loop fashion, it becomes a vicious cycle where the currency falls, the inflation shoots up, interest rate moves up, and finally it brings down the forex reserves, because the central bank in those countries start defending the currency using their forex reserves, which are built during those easy times, right? That's how the whole thing happens. Now, so the key thing for emerging markets in this kind of a cycle is the level of confidence from global investors on the macro metrics. That's a very, very important thing. The level of comfort comes on the macro. The level of confidence generally comes from, there are certain factors which they look at closely, which is the level of forex reserves, the level of current account deficit, fiscal deficit, and central bank's credibility in terms of tackling inflation. So those are the things the investors look at. Now, and that's where I think they start assessing the economy, and then they start pulling out money, which leads to a vicious cycle, right? If the cycle gets broken, it becomes a huge problem for the emerging markets. Now, where does India stand in this? Which is what we have been, we want to explore. In terms of level of comfort, I think there are a lot of positives going for India, except one. So the positives are the forex reserves. We are at a very, very comfortable level. And today it covers more than 11 months of imports, which is reasonably high. Anything below 4 months of import is what is the red flag for any economy. So we are far above that. And central bank's ability to tackle inflation, raise the interest rates ahead of the curve is very high for India's central bank. And in terms of rupee's resilience, I think we have been reasonably high. But there is one sticky spot for India. That comes from our vulnerability in current account deficit, right? And this has been a potential landmine for India historically. So whenever there is a down cycle, when Fed starts tightening, our CAD, which is our current account deficit, shoots up, and it goes to a level which is unsustainable, right? Somewhere around 4% of GDP becomes unsustainable. And that's when I think investors start getting panicky and then start pulling out money, which leads to a vicious cycle. So where do we stand on that today? So to understand that, I think let's go back and look at how our situation in a similar cycle like 2013 and where we are now. There is a very interesting insight we can get from this. In 2013, when taper tantrum played out, look at the oil imports and our software export income. And these two data points are very critical to assess where do we stand in terms of our CAD vulnerability. So in 2014, I think our oil imports were about $140 billion, right? And our software exports were about $70 billion, which means oil imports were 2x of software exports. Today, the software exports has grown in the last decade from 2014 to 2022. It has grown to close to about $178 billion. Whereas oil import is stagnated or marginal decline from 140 billion to $130 billion now, $130 billion in FY22. This makes a huge difference in terms of our macro comfort. So in 2014, oil imports were 2x level of software exports, whereas in FY22, we have the software export is a multiple of oil imports by a factor of 1.3 times. Now, given the NASSCOM forecast for software exports to touch close to about $300 billion by FY25-26, this is going to be because of super digitalization cycle and a massive cloud adoption across the globe. Said our software exports are projected to touch about $300+ billion by FY26. You can imagine this comfort in macro in terms of CAD vulnerability is going to increase multifold in the coming 3-4 years. You look at another data point in FY14. In terms of import to GDP ratio, oil imports, the share of oil imports on the GDP, on the overall imports used to be around 30%. Whereas today, oil import is overall, I mean, even at this elevated level of $100 billion, $100 per barrel, we are at about 20%. So that tells you what kind of comfort we have in terms of macro. So actually, India has come a long way in terms of macro risk profile, in terms of CAD vulnerability from FY14, right? From the time when it was clubbed as a fragile 5 economies. This is a very, very important development in our view. I think this particular development is single-handedly will change the contours of our macro risk profile. This is the most under-debated and I would say least understood phenomenon among the investment community. Also, adding to this, the rising comfort in terms of domestic macro in terms of banks' balance sheets and corporate balance sheets. We have just with corporate and bank balance sheets behind, NPA cleanup cycle behind. I think our macro has improved dramatically, and the risk of potential accidents, like what happened in terms of ILFs in 2018 cycle. With those kind of risk receding, I think India is relatively one of the few shining spots for global investors, in terms of investment destinations. So this is probably one of the reasons why you are seeing surge in, some of the private equity and VC investments in India. Look at the data points. In the last, in this calendar year, you have close to about $25 billion of FI money which has moved out of India. Same time, we have seen $34 billion of PVC investments in India. And that is almost 28% more than what India received in terms of PE and VC investments last year. That's one data point. Second data point is like RBI governor announced as part of the press statement yesterday. He said the FDI investments in the first 6 months of this year was about 13 billion odd, compared to about 11 billion odd last year. So, in this kind of crisis situation where the neighboring countries are depleting forex reserves, we are seeing surge in investments, into India, thanks to the rising comfort in terms of India's macro. thanks to the rising comfort in terms of India's prospects for growth. This emerging comfort in terms of macro stability, progressive policy environment, relative, rupees resilience, relative rupees strength, is probably the reason why there is a rising confidence in terms of domestic investment community. And this is in a way reflected in terms of, raising huge resilience we are seeing, what Indian markets have demonstrated in this particular downside. So with this, only time will tell whether this prognosis is right, but this is an interesting time to watch out for how India's macro, is going to be in the coming months when a lot of countries are really, fragile in terms of their macro profile. So let's watch this space. It's going to be interesting. With this, let me conclude, my commentary on the topic which we have chosen today. Before throwing the floor open for the, throwing the floor open for Q&A, let me also take a few minutes and, probably give our insights and perspective in terms of where do we stand in terms of market view, the equity markets view for India. So when you look at the Indian market outlook, there's one thing which is coming out very clear. The worry for global investors today has shifted from inflation to growth. 3-4 months back, the top of the worry for global investors was inflation. Today, it is no longer inflation because the prices have cracked, the commodity index is cracked. Look at palm oil, edible oil, I think, which is now down 40% from the peak. You look at crude oil, I think Brent is now gone back to pre-Ukraine days. We are at $94 per barrel, which is almost what was there before the conflict started in Russia. So that way, I think the commodity prices have cracked. There's, look at chip prices, they're down, freight rates, they're coming down. So the inflation is peaked, and the peak of the inflation is behind us. Of course, it might take a little longer time for that to reflect in the CPI numbers, because there's always a lag effect in terms of when it gets reflected in the CPI. But for the global investors, the worry has become the growth, not so much the inflation. So in this kind of settings, what we expect is the Fed is likely to become less and less hawkish in the second half. They'll keep sucking liquidity through, tightening. That is likely to continue, but they will become less and less hawkish, which will give a lot more comfort to the market. One key difference between 3-4 months back and today is on the view on the recession. Earlier, the consensus view was that the Fed will accelerate the tightening. They will keep, they will accelerate the interest rate hiking, which might, potentially result in deeper recession in US. Today, the view is slowly changing, with a view emerging that the inflation is behind and the growth is more of a concern. The Fed is likely to become less hawkish, which means there is less likely chance of a deep or hard landing for US. You might end up with a mild recession, but very unlikely that you will have a very deep recession. But the emerging view is that for countries like India, which is very, very import intensive and where the demand is more driven by domestic consumption, a mild recession could turn to be a very good playbook for India. So that's a very interesting view emerging for India. If there is a mild recession, US potentially it could benefit India, because the commodity prices will come down further, and India being an import-intensive economy with domestic-driven demand, we might benefit from there. This, in a way, is getting reflected in the market today. Look at Nifty in this month. I mean, from July 1st, I think Nifty is up by about, Sensex and Nifty is up by about 10%. Small cap index is up by about 12%. From the June lows, if you look at, Nifty is up by about 14% and small cap index is up by 18%. So that way, I think it's brought a lot of confidence to investors. And for the first time in the last 9 months, FIs have become net buyers in the month of July. So July, I think they had bought a net of about 5,000 crores. And in the first 5 days of August, just 5 days, I think they have put almost close to $1 billion FI net inflows. So that is in a way reflecting in the currency, because currency, after hitting 80, it slowly started strengthening a bit. It's still at an elevated level, but the risk is slowly coming down. The whole view is it does not mean that all the risks have gone away. You still have, gas supply chain issues with respect to Europe, which could hit them hard. So Europe could get into a, deeper recession. Also, China's property backlash, so one doesn't really know to what extent it will play out. So there are a lot of issues. Still, Evergrande issue, is still open, and Chinese clampdown on real estate sector, how it will feed through into the overall demand for China, we really don't know. Their purchase managers index, all that is very soft, and their economy is likely to grow only by 3.5% this year. The optimistic projection for China. So those are issues that are still there, and the new Taiwan angle has also come to play a role in the overall risk profile for the markets. So we really don't know how this will all play out, but all said and done, I think going by our experience of past cycles, such macro events, whatever may happen in those geopolitical as well as on the recessionary trends, what we have seen is none of these macro risks had any lasting impact beyond few quarters. I think please mark our words, none of these macro events. We have been in this business for 20 years. We've seen at least 3-4 cycles, and none of these macro events have had a lasting impact beyond few quarters. Always in hindsight, always, please mark this, always in hindsight, all these macro events and the related corrections have been a big opportunity in hindsight. So this is the best time in terms of building stock specific bottom up portfolios for long-term investors. Though in the short horizon, dust is there to settle. With this, let me conclude my commentary. So thanks a lot, all the participants. I really appreciate all of you taking time on a weekend to attend this. As much as we enjoyed, I hope this session was very useful and enjoyable and informative for all of you. And look forward to be in touch. Any queries, anything, we will be always glad to be of use to you. So anytime you can approach us, and our people are there, our team is there. Anything required, any relevant information, you can also access our website, and we are also present in all our social media, including YouTube channels. Please do subscribe, and then we would look forward to be in touch with you. Thanks a lot. Thanks once again.